Everyone's telling you the same story. Funding is dead, startups are screwed, and if you can't raise right now, you should probably just give up and get a job at a bank. And you know what? They're dead wrong, and I'm going to prove it. While every other founder is out here complaining about how hard it is, I'm here to tell you that right now, today, might be the single best moment in the last decade to build something that actually scales. I know you probably think I'm nuts. I know the data looks terrible. I know you're watching other founders shut down their companies. But what if I told you that all of that, every bit of that pain, is precisely what's about to make the next wave of truly great companies unstoppable? What if the worst funding environment in years is actually a massive gift that most founders are too scared or too distracted to unwrap? Stick with me, because if you can handle what I'm about to say, you're going to see an opportunity that 99% of other founders are completely blind to right now. If you look at the aggregated numbers for 2025 through the lens of venture capital's biggest cheerleader, the National Venture Capital Association, or NVCA, the headline numbers seem great. 2025 turned out to be a pretty good year for overall deal value, hitting highs in Q4 we haven't seen since before the pandemic. But most of those deals were later stage deals and consolidated into only a handful of companies. In fact, NVCA reports 50% of the 2025 deal value was invested in just 0.05% of the completed deals. Each quarter of 2025 also had more than $50 billion invested in mega deals. Crunchbase cites that there was a 30% jump in total funding compared to 2024. Almost all of that increase went into a handful of these monster rounds. So this trend of seeing more money consolidating around fewer deals continued throughout 2025. Making access to funds for the average startups more challenging than ever. In case you've seen the glowing proclamations from industry pundits declaring VC is back, baby, you have to read past the headline numbers. If you only look at those clickbait headers, you'd see a banner year in total investment in seed stage companies in 2025, but that number also includes Thinking Machines Labs and unconventional AI, which brought in a staggering $2.4 billion combined as seed stage financing. Strip those out, and it was a pretty rough year for seed stage fundraising. So why is this happening? There are a couple of reasons, and I'll keep it brief to avoid going full finance dork. First, investors are being much more selective. They don't want to fund long shots, consumer-facing apps, risky fintechs, or niche plays. Second, early-stage investors are mostly syndicators. They don't lead rounds. And now that their buddies aren't bringing them deals and the AI rounds are too expensive for them to get a piece of, they're a VC fund in name only. On an annualized basis, they're placing a fraction of the investments they made just a couple of years ago. Third, many funds have been doubling down on protecting their existing investments, deploying capital into helping their current companies survive this era of venture asymmetry. Fourth, early-stage fund managers have moved the goalpost. They now expect even seed-stage companies to have profitable unit economics, established product-market fit, and a clear path to profitability, all thresholds that didn't exist even a few years ago. Lastly, limited partners are being a lot more selective in placing their dollars with fund managers, especially emerging fund managers who dominate early-stage fund management. That means the funds that want to invest in early-stage companies can't raise the money to do it. While the ink on the data is still drying when it comes to 2025, 2024 saw a 26% increase in the number of startups that failed when compared to 2023. And the projections for how 2025 will shake out are pretty grim. Most of those failures come between seed stage and Series A, where startups run out of cash through a combination of slow market adoption, pivots around their go-to-market strategy, and just bad luck. Seed stage startup survival is brutal. You have to nail almost every aspect of your company's development. Your target market must be right, product development is focused and ships on time, you have all the right people, your budgeting for burn is immaculate, the margin for error is razor thin. The current amount of time between a seed stage fundraise and Series A is now more than 2 years. Just a couple of years ago, it was 18 months. 6 months may not seem like a long time, but it only takes a few months to burn through remaining cash when any of the above scenarios isn't playing out the way you've hoped. Now, that all seems properly horrible and in direct contradiction to the opening of this episode, but there is a glass half full scenario here. 2026 may actually be the best time for startups to grow. You know, one of the best ways to support small YouTube channels is to subscribe to the channel. So if you're enjoying this content and like to see more of it, consider subscribing. Back to the episode. Let's start with a nerdy number related to dry powder. VCs like to make what they do sound complicated or even macho. The They use the term dry powder as a way to refer to the amount of capital they have at their disposal to invest. It's a reference to having dry powder necessary to fire a musket. Trust me when I say most of these guys don't even know which is the working end of a rifle, but they sure do like to project masculinity when given the opportunity. It's also ironic because dry powder accumulates when those same investors have been chicken shit about deploying capital out of fear or lack of skill when markets show even the smallest amount of uncertainty. Dry powder right now is at a historically high level. That means investors have a lot of capital they've been tasked with deploying. That's good news for startups. The only surprise here, to me, is that this amount of dry powder has been allowed to accumulate. These fund managers are paid to deploy capital, not sit on it. For the last 4 years, investors have been allowing it. So LPs are paying management fees to fund managers who aren't making new investments. Make it make sense. Now, couple that dry powder with fewer early-stage companies getting funded, the field of competitors just shrank for the truly fundable startups. If fewer crap startups are being funded, that leaves the best investment-grade founders for investors to take seriously. And that could be you. But you need to be investment grade, and that may force you to reevaluate your strategy and structure. First, you need to go further with less capital. No more using multiple millions of dollars to find product market fit. No more failing forward. You need to nail your marks consistently on time and on budget. If you don't have provable PMF, don't even attempt to raise more money. Go-to-market and revenue generation timelines must be halved, if not accelerated even more. You need a sellable product in market and showing signs of scalable traction. Even if this means selling a smaller or less robust version of your product, that must be part of your strategy. Thoughts and prayers around your unit economics is no longer a viable tactic. Start with profitable and compelling unit economics. Investors won't give you the time and grace for those to develop over time. Products and revenue generation built on the foundation of profitable unit economics is now the standard. Startups need to grow up more quickly. Products have to be aimed at real, urgent, and complex problems. Dating apps and AI bots that help you get your dry cleaning done need not apply. All B2C products need to be internally scrutinized. Consumer spending is tightening, and models that rely on consumers' problems that could, at worst, be described as a nuisance are going to find fundraising extremely difficult in 2026. Only the big and complex problems are going to find big enough markets to get the attention of investors. I would recommend building products that can address, at a minimum, an annual market of at least $10 billion. Even that number may be low. A piece of good news buried in the pile here, that investor selectivity and the need for your startup to be much further with less funding is the counterbalance to the ease at which code can now be written, that anyone can spin up a shitty app in an afternoon. For those of you that have built real products and haven't vibe coded your way into a dysfunctional AI wrapper, code and engineering no longer offer differentiation or defensibility. The actual product needs to be really strong and serving a high potential market. AI has democratized product development and made it available to the masses. High-level engineering will always need expert humans, but shipping basic products, bug fixes, and updates no longer requires a degree in computer science. Most of this can be lumped into the idea of forced discipline for founders and their startups. That discipline includes making seed or angel money last, creating business models that can actually create a path to profitability without any additional capital, go further with smaller teams, and fundraise for growth, not survival. Sound impossible? I don't think so. It does require a complete reset of how founders have traditionally thought about funding their growth and what to prioritize in early days. For those of you thinking this all sounds great, but how am I supposed to get to investment grade without any money? I get it. The whole thing can feel like a chicken and the egg problem, but the path forward has changed. If you're still thinking you need millions to prove anything, you're already doomed. The move now is to bootstrap smarter, not harder. That doesn't mean grinding for years in your parents' basement. It means being strategic about how you sequence your path to fundability. First, pre-sell before you build. I'm talking about going to potential customers with mock-ups, with prototypes, with anything that communicates your vision and getting them to commit real money before you write a single line of production code. If you can't convince a handful of people to give you money for something that doesn't exist yet, why would an investor give you millions to build it? Second, find design partners that will pay you for early access. Not beta testers who want free stuff, paying design partners. These are customers who see so much value in what you're building that they'll fund its development in exchange for early access and input into the roadmap. Third, consider alternative non-dilutive funding. Do you qualify for grants? Can you win a few pitch competitions? Can you do a few select one-off builds for customers using a code or tech you've already developed? Fourth, sell a smaller or early version of the product now. Actually ship. Your MVP should already do at least one thing exceptionally well. Sell that. Strip it down to the absolute core value proposition and get it in front of paying customers immediately. The old fundraising model was built for 6 months, raise a pre-seed, build for another 6 months, raise a seed, burn through runway trying to find product market fit, then pray you can raise a Series A before you run out of cash. That model is dead. The new model is validate there's a real problem, monetize it immediately even if it's scrappy, then raise capital to scale what's already working. If all of this sounds too hard or too unlikely, quit now, because this is easy compared to what will be required of you as a founder after you take investor money. This isn't about building a lifestyle business. This is about proving beyond any doubt that your business model works before you ask someone else to bet on it. When you can walk into a pitch and say, we've got $50K in ARR, we're growing 25% month over month, our CAC payback is 8 months, and we've done all of this on $100K. That's a completely different conversation than we have this great idea and we need $2 million to see if it works. The companies that are going to win in this environment are the ones that treat investor capital as fuel for growth, not as a life jacket. Now, let me be brutally honest with you, because if I'm not, I'm doing you a disservice. Most of you listening to this right now won't actually make these changes. You'll hear everything I've said, you'll nod along, you might even take some notes. But when you close this and get back to your startup, you're going to keep doing exactly what you've been doing. You'll keep pitching investors the same way, hoping that this time someone will see your vision. You'll keep telling yourself that you just need a little more time, a little more runway, then everything will click into place. You'll keep waiting for the market to shift back to handing out dumb money, back to 2021 when capital was falling from the sky and investors were offering competitive term sheets. And I get it, change is hard. Admitting that your current approach isn't working is defeating. Acknowledging that you might need to completely rethink your business model or your market or even your entire product, that's a tough proposition. But here's the thing, that resistance, that inability to adapt, that's exactly why this opportunity exists for the founders who will adapt. The vast majority of founders out there right now, they're going to keep operating from that 2020 playbook. They're going to keep burning through cash. They're going to keep building products that are trendy but not essential. They're going to keep missing their milestones and blaming the fundraising environment instead of being accountable for a poorly conceived strategy and mediocre execution. And they're going to fail. Not because they're bad people or because they're stupid, but because they wouldn't adapt to a market that's fundamentally changed. The question you need to ask yourself is, are you disciplined enough to do what actually works, even when it's uncomfortable? Most founders can't do that. They fall in love with their vision and they can't let it go, even when the market is screaming that it doesn't work. So here's my challenge to you. Prove that you're not like most founders. Prove that you can take an honest look at your business, strip away the bullshit, and build something that's fundable in 2026. Because if you can, if you're one of the few who actually adapts, you're going to look back at 2026 as a year that everything changed for you. Not because the market got easier, but because you got better. The opportunity is real. The dry powder is piled up. The lack of true competition is palpable. So what have we learned? Funding for startups is still tight. Fewer early stage companies are surviving. Investors are still a pain in the ass between a lack of conviction and hoarding cash. The rules have changed. Startups need to adapt their strategy and thinking. The opportunity for the absolutely best startups to grow, raise capital, and scale may never have been better than right now. Here's what now separates you from everyone else. You now have a perspective they don't. You understand that this market isn't your enemy, it's your opportunity. While their founders are paralyzed, waiting for some pivotal moment when VCs start writing checks again, you're going to be moving forward, building, executing. When that dry powder finally does deploy, when investors wake up and realize they've been sitting on billions while the clock's been ticking, your company is going to be so fundamentally sound, so undeniably investable, that you won't be chasing them anymore, they'll be chasing you. This isn't about surviving until things get better. This is about using this exact moment right now, with all its constraints and challenges, to build something so strong that by the time everyone else figures out what you already know, you'll be untouchable. The opportunity is sitting right in front of you. Most people are going to walk right past it, but you're not most people. That's it for this episode. As always, like, comment, and subscribe. We'll see you next time.